Now, we've talked about people, we had Bullard saying 100 basis points by July, some say 175. What do you see the Fed doing?
The Fed told you themselves back in December, policy's in the wrong place. I mean, really, this has been a 2-month process of acknowledging reality, and now they're going to start raising rates. I think what Bullard really told you is that at some point, an increment of 50 has got to be considered, whether it's March or June is less clear. I think if CPI's print last night was PCE, then you could guarantee it was 50 in March. But now you're 85% priced for 50 in March. It's not going to be a surprise. The door's open. They can do it if they want to. But what was always mispriced in the curve was that the probability that the increment or the dosage could go to 50 at some point, and now the market understands that's the case.
Lots of questions whether we've seen the end of the bull market for bonds. Of course, people have been talking about that for the past, 40 years or whatever. Are we finally there? And have you been surprised by the great demand at this week's auction? I mean, how do you make sense of that?
I think there are two things going on. First, you got to talk about which bonds. So remember, what's really changed is what we would argue is the long-term demand for treasuries, for example. Now, if you've been long Chinese duration the whole year, Chinese rates are lower. Chinese bonds have acted as hard duration. We've been involved in China for the entire sort of policy divergence trade. In global bonds, global DM bonds, the way we like to think about it is the era of policy, or rather just disinflation, is over. That's been over, frankly, since mid-20. And once you move into a different state, you're in something where you're going to get very big cyclical swings in inflation. And that makes bonds a whole lot less attractive. And there is certainly an argument to be made that you are in a long-term inflationary paradigm, because the move to sort of green energy, the required investment, the increased sort of embedded social fiscal programs, et cetera, and demographics all sort of lead you to a higher inflationary floor than we've experienced over the last 20 years. I don't know that you need to declare that bonds will never rally again yet. And in fact, as you know, real money bond managers have been running short duration, so you show up in auctions periodically to cover some amount of that duration short, as they've already made a certain amount of alpha for the year in a very short period of time.
So having said that, how are you positioned in the bond market?
We've been short the front end of DM across the board, US, Europe, Japan, and long China, essentially. And now that trade has played out, particularly last night, and it's a lot less easy of a trade at this point in reality. As I said, if they go 50 at this point in March, you're making another 5 basis points. So that trade, the way that we'll approach the bond market, you can consistently sell rallies, because the tension that exists is going to be that you do have an argument that PMIs have already started to slow, and that they're hiking into a slowdown, and therefore you'll have something break, and bonds will rally back. That's a reasonable position to have. Conversely, we spend a lot of time in supply chains, particularly the supply chains of macro importance, whether it's semis or autos or oil services. And in semis, we've actually picked up a reacceleration recently. In autos, you have the Japanese automakers telling you that they're going to have product to sell, for example, so their sell-through will be a lot higher. And we have SAR going up in the US, for example. And then, oil field service CapEx this year is going to be much higher than expected.
So how does the 2022 playbook look like for you? Give us a sense of how your portfolio looks like right now.
Our portfolio is basically the anti-portfolio of what was the last 10 years, right? I mean, in reality, what's been vulnerable in the market is the embedded consensus buildup of positions for 10 years. For the last 10 years, all the flows have been into the US at the expense of the rest of the world, and essentially into US tech. And that's what's obviously vulnerable, because you have to migrate portfolios away from those entrenched embedded positions as you change the environment, as you go to an environment that's going to have much higher concurrent inflation. And so there's a lot of value out there. Obviously, you've seen the growth value rotation trade within the U.S., for example, and you see it, somewhat in Europe, and you've definitely seen it in Japan this year. But there's tremendous value in emerging markets, sort of value stocks within markets that themselves value of value, that have been left for dead, essentially, over the last 10 years. And you can note that all that stuff is actually up this year. It's actually up, overnight as well. That's very telling. That's where all of our interest is in our portfolio.
So Adam, maybe break it down a little bit further. It's Yvonne, by the way. Thanks so much for joining us. If you take a look across asset classes, whether it's stocks, bonds, FX, even commodities and crypto, what sort of opportunities are most compelling in this environment to you now?
You want the entire, every asset class at once. So I'll start with...
maybe the top three.
Sure. Well, no, look, in fixed income, I don't find fixed income compelling anywhere but China. And China, even at this point, will be mostly a placeholder and a grinding trade. In foreign exchange, our view has been that you actually want to be short the dollar. I'm actually very encouraged by performance overnight. For such a sharp move in rates, the dollar hasn't responded much at all. And that's again, a reflection of this shift in flows from the embedded portfolio in U.S. growth. And as capital exporting countries, the Koreas and Thailands and Europe, regions of the world, get those flows back, those currencies actually end up appreciating in this environment, as opposed to just going with rates, because the rate trade is not a U.S. exceptionalism story. Within equities, it's basically being short elements in the U.S., in particular, long value markets, whether it's Japan or Europe, or long particular segments of value within the EM. I mean, everywhere from Brazil to Kazakhstan to Greece. You're finding domestic franchises that are so cheap that you can't manufacture them in the private equity markets at anything close to where they trade. So things like 4 to 5, 6 times earnings, visible cash flows, paying dividends. That stuff can rally a long way because it takes just a small migration of these flows into those markets, because there isn't that much liquidity. As people have abandoned these markets, and you get very discrete price adjustments.
And you mentioned before, you've been playing this sort of policy divergence between the Fed and the PBOC. I'm wondering, we've seen that in the bond market play out, not so much in the equity markets. This week, there was a lot of focus on these state-backed funds and intervening in the local stock market right now. How do you interpret that? Yeah. And do you actually position around it in that way? In what way? Yeah,
we're positioned for it, particularly because we think that there's been an inflection in the China credit impulse. You saw the TSF numbers released the other day were incredibly strong. If you look at historically when you've seen TSF increments of this nature in relative terms, Chinese equities have done very well the following year. It's not a sort of 1 week proposition, but over the ensuing year. And so we're somewhat constructive. The problem with China, and so China in our view should be part of your EM basket. I don't think you want to be necessarily concentrated in China relative to other markets yet, because the nature of the impulse of the inflection is still rather incipient. But the change in policy intent is pretty clear. And if you look at old line industries in China, whether it's the ag sector or financials, those have performed just fine. And then on top of it, if you overlay another filter around security, because we live in this new world of strategic rivalry, right? And so I'll use an example like the oil industry. It's our contention that China will never, there will never be another drilling contract for a U.S. Oil field service company in China. So those will all now be domestic order flow, and those companies are very cheap in China, and we're involved in that segment.
You're obviously seeing value in crypto. You started
Yep.
a fund just as cryptocurrencies were spiraling down. I'm just wondering, how do you trade amid all the volatility?
In crypto?
Yep.
The cryptos, you got to rewind a little bit. Like, we've been involved in crypto materially since 2013. So we're at a very different stage than over the past. It's a highly volatile asset, but it's always been a macro asset in our view. So what's happened this year is you've moved to an environment where the Fed is being forced to raise rates, as are other central banks, and you're seeing a change in the extremely abundant liquidity environment. Crypto suffered. Crypto's basically traded as a risk asset, looking like a growth equity. That's not a surprise. Largely because this year, in our view, will be about greater institutional adoption, particularly in layer ones. But while the allocation decision has been made by a lot of traditional institutions, the implementation hasn't occurred yet in many cases. They've been very slow. They don't want their first foray into the space to be a money-losing proposition quickly. And so I think it's going to be a situation where that crypto trades better than growth equities over the middle of the year, but these institutional allocations will wait until the global equity markets, particularly growth equities, stabilize.
To your point, there are lots of naysayers. We had the RBI saying crypto is not even a tulip. I mean, in your view, I'm just wondering, what will do well this year?
In digital?
The crypto space,
in digital?
Yes.
I think that our premise is the challenger layer ones will be very very interesting place to be this year, whether it's the Avalanches or Matics or Lunas. And in addition, if you spend time in sort of the metaverse-related tokens, and you step away from the volatility, the under the hood, so to speak, if you think about or look at on-chain analytics of unique addresses, or actual selling price of digital land, or the volume of sales, all of those are near the highs, and you have new real-world businesses entering that space literally every week. Everybody from Sun Hung Kai, which is now developing digital land properties in Sandbox, and Gucci entered last week, Sandbox as well. There are a lot of those examples. So within the actual development of that space, there's nothing that sort of deters us from more investment in sort of the creator economy more broadly.